Welcome to the Trading with Venus podcast, where we help you establish strong trading habits, generate consistent profits, and create the lifestyle you desire for yourself and your family. Now your host, Raman Gill.
Welcome to another episode of the Trading with Venus podcast. This is your host, Raman. Just a quick disclaimer before we get started here. This is for educational purposes only. Trading is a risky business, so please be careful with your money. All right, so today we'll talk about understanding the news report, and specifically we'll talk about the CPI, which is also called inflation. But before we can understand the CPI number, we need to have an understanding of interest rates and monetary policy, as they are all tied together here. So interest rates. So interest rates are one of the biggest factor in determining the value of the currency. So US dollar overall has done well because Fed has been raising rates. So it's the central bank is the one who will set a country's monetary policy, and part of the monetary policy is the interest rate, right? So when there are different components of monetary policy, interest rate is one of them. Other will be how much their asset purchase program, for example, when the country or the economy is not doing so well, we see that countries will have what's called an expansionary monetary policy, which means they are pumping money into the economy. And as the economies start to get better, the central bank will then try to take that money out of the market, because if they keep the money in the market, things will get too expensive. And that's where the inflation comes into play. So they don't want the inflation to be too high. So they don't want the cost of goods to become too expensive. So they will start taking the money out of the economy. So they won't be purchasing the assets from the banks as much. So currently the environment that we are in is where the banks are they have started tightening the monetary policy. For the last 10 years, we have been in this expansionary monetary policy mode from pretty much all the central banks around the world. That's because after that global financial crash in 2008, 2009, everybody needed help. Right? The different economies were not doing so well. Things crashed across the board. Markets were not doing well. And the trade in the markets was not going well. So the governments had to step in and provide liquidity to the banks. So basically what they were doing they were buying these securities like bonds from the banks so that they would have money to give to the banks, because they can't just give the money to the bank. There has to be a mechanism for providing liquidity to the banks. So they would buy these bonds from the bank. In return, they would give cash to the banks. So when the banks have cash, then they are able to give that cash out as loans to businesses, people, and it kickstarts the economy. Because after the financial crash, the banks stopped lending money because, one, they didn't have as much money to lend because their deposit rates and everything else dropped. And they have to be careful of their reserves. So they have to have a certain amount of money in reserve that they cannot lend out. So, and secondly, because people didn't have jobs and the businesses were not doing so well. And so the banks were not interested in lending the money because there was huge risk that that money would not get returned. So the governments would step in, provide this money to the banks by buying bonds from them, provide this money to the banks, and then the banks would have sufficient funds to lend out to everybody. And once people have money in their hands, businesses can do more with the money. They can actually go, employ people, they can buy machinery, they can buy products or raw products and stuff like that. So it kickstarts the economy and it creates this flow of money. And that's why even doing like mortgages at lower rates or giving low interest car loans and stuff like that, it just creates this circulation of money, which is good for the economy because it keeps people employed, keeps people making money. So that's the whole expansionary monetary policy side of things. So big influence that the central banks have on the interest rate decision is how the prices are doing. right? If the prices start to go up too much, that's a problem because it just creates this overinflation in everything, and then things become out of reach for the normal people. And as a result, central banks have to really pay attention to the price stability. And what they do want in terms of inflation is that they want the prices to go up steadily, like year over year. They want goods and services to go up like 2% is kind of the 2 to 3% is where they want the inflation rate to be. So moderate inflation is good for economic growth, whereas too much inflation is bad because nobody can afford anything. And when you start to get negative inflation, that's a big concern as well, because that means that something is wrong with the economy and it indicates that there's going to be a problem soon. And that's why it's very, very important that we pay attention to the inflation. So this is what we talked about in just a little in terms of the expansionary monetary policy. So now what's going on is that banks are cutting back. Right, they are going into this tightening of monetary policy. So we have seen Bank of Canada do that. We have seen Fed do that. We have seen Bank of England do an interest rate hike, and then ECB is cutting back on their asset purchase program. That's part of tightening as well. They have not raised rates yet, but that's the next step. So those are the two things in the monetary policy, and now the next step will be the interest rate hike. So how does it work when the interest rates go up? So when the interest rates increase, borrowing becomes more expensive, right? So everybody, when the prime rate is low, people can borrow money at a cheap interest rate. But when the interest rates start to go up, borrowing is more expensive. So if you go to get a mortgage, it'll be more expensive. If you go to get a car loan or a business loan or a personal loan, everything becomes more expensive. And when people are paying more towards debt servicing, so that they're paying more towards their interest than their down payment, that becomes a problem, right? People don't want to pay as much, so they tend to spend less during those times, or the spending will then decrease because things are more expensive because of the higher interest rate. And when they're spending less, then the growth goes down because there's not as much money going around circulating in the economy. And when the growth decreases, it points to lower inflation. And lower inflation means that they're not going to raise interest rates, and they will stay where it is. And this is what we saw from we saw from the US yesterday. CPI rate was lower than expected. US has not had the inflation that it should be showing with the amount of growth that we have seen in the economy. When the economy is doing well, inflation should go up as well. We have seen that with UK. UK is at 2 to 3% inflation, which is a good rate of inflation. And they are concerned about overinflation. That's why Bank of England stepped in and did an interest rate hike, because right now, Brexit concerns, it's not a good time for them to do interest rate hikes because there are already concerns in the economy. But they had to step in because the inflation was getting to that 3% level, and they didn't want it to overshoot. So they had to step in and do an interest rate hike in order to control the cycle. So that's where the CPI is important, because it points to whether the central bank will raise rates or not. So when we have interest rate hike, it will slow down the economic growth and inflation will be slower. But when the interest rates are cut, it points to higher economic growth and faster inflation. So if the inflation slows down right here, if the inflation slows down, it will have opposite impact. It means lower economic growth, and they may have to do interest rate cut. So that's why CPI is very important, because it starts to go comes lower than expected. It means that there's a problem in the economy, and things are not matching up because they are supposed to match up. Okay. Another thing that where interest rates come into play is the flow of capital in and out of the country. So investors, now that we are a global economy, investors are looking for best place to invest their money where they can get the highest return. And the country that has the highest interest rate generally means that the investment is better. Now, having said that, keep in mind that the developing countries, emerging economies tend to have higher interest rates, but there is risk. There's political risk. There are other risks within those countries, so they don't make really good investment choices at times because the investors are looking to balance the growth, the interest that they're getting with the safety of the capital as well. When you're investing in a developing country, your capital is safer than investing in an emerging market because political problems or other problems will come up that could put your capital at risk. So when developing countries start to provide higher interest rates, that creates a flow of capital into those economies. So with the US raising interest rates, now anybody who were to buy their T-bills or bonds and stuff like that, really safe investments, you could get a higher rate of interest than you were getting before. And so people may be sort of more interested in investing in those countries, investing in the stock market in those countries because they are growing economies and they would get better return on their money because things are going up. So if they want higher risk, they can invest in the stock market. If they want lower risk, they will go towards the bond market. So that's how the interest rate will create this inflow of money from other places into the country. And as the money comes into the market, they have to buy that currency. So let's say I am an Australian, I want to buy bonds from US, right? So I have to convert my Australian dollars into US currency in order to buy that. So when I convert that currency, when I'm buying those US dollars, with lots of people buying the US dollar, the demand for US dollar goes up. And when the demand for US dollar goes up, it pushes the prices for US dollars up. So this is where when other people want to invest in that country, it pushes the prices up for that currency as well. So overall, big takeaway here is that the interest rates will have a direct impact on how the global market players will feel about the currency's value relative to another country. So this is where they want to invest. Okay, so interest rate differential. What is an interest rate differential? It basically is comparing one country's interest rate with another country's interest rate. And we have seen a big interest rate differential in US dollar versus Australian dollar, right? So our US versus Australia, US versus New Zealand, there has been an interest rate differential. There was time when Australia and New Zealand would have higher interest rates than the US would. But what US has been doing over the last year or so is that they have been raising rates, and Australia and New Zealand have been just staying steady with their interest rate. And as a result, it's created this interest rate differential. That means the difference in the interest rates between two different countries. So basically what you can do is take money from one country and you can put it into another country's because you get higher interest rate. The biggest difference tends to be between Japanese yen and pretty much anything else because Japan has a negative interest rate. So you're basically, if you were to go buy bonds in Japan, you're literally losing money, right? You're not getting anything. So if you were to take Japanese yen, and that's why the carry trades come into play, because you could borrow the money in Japan, in Japanese yen, and then you could use that money to invest in the US. So if you were just buying bonds, you get that interest rate differential. Now, if you were to take the money take a loan in Japan and then invest that money in the stock market, you're getting multiple times the return on that money that you have borrowed. So that's the interest rate differential, where you can borrow money in one place and then you can go invest it. Even if you were to just buy bonds, you're not really, you're not making any sort of risky investments, your rate of return still will be higher because that bond will give you a higher rate of interest than you would get in Japan. So this is where the interest rate differential comes in, and investors will move their money from lower yielding currency, which is like Japan, that the interest rates are low, into the higher yielding country or currency where the interest rates are higher. So that's called the interest rate differential. And we are seeing that between US and Japan, US and Australia, US and New Zealand. Those are the current countries that show that interest rate differential. And then we need to talk about, when we're talking about inflation. Now, we are kind of getting heavy into this, but this is very important for us to understand as traders. So the next thing is nominal versus real interest rate. Now, what is the difference here? So nominal interest rate is basically the interest rate that is quoted, right? So you go to the bank and you get your, whatever the prime rate is, that's your nominal interest rate, right? What that does not take into account is the inflation that's expected, right? So let's say you were to lend money to somebody and you got paid a 5% interest rate, right? That sounds really good because if you go to the bank, they will not give you that interest rate if you were to deposit money into the bank at the moment. But let's say the inflation was at 2%. Right? So every year, year over year, your cost of goods gets expensive by 2%. That means your real interest rate is really 3% because you have to account for that inflation. You don't get the money in your pocket because the cost of goods is more expensive. So that's called real interest rate, whatever the difference is between the quoted interest rate and the inflation. The difference there is the real interest rate. That's why we always have to pay attention to inflation. And this is why inflation is so important, because if it's super high, let's say you're getting a 5% interest rate and your inflation is 4%. So literally you made 1%, right? And that is not a good rate of return. Even though the quoted rate is 5%, you only made 1% in real terms, because cost of everything else went up that much. And that's what the central banks don't want. They do not want inflation to be too high, because it was like, I think in Zimbabwe, a few years ago, where to buy a loaf of bread, you needed like $1 million of their money to buy a loaf of bread, which is, things can get out of hand if that were the case. So everything will become super expensive. So this is where the inflation becomes very expensive. So always when you're looking at interest rates, not only do we have to look at nominal interest rate, what's called quoted, but what the real interest rate is as well. And if the inflation is high, it cuts into the interest rates that people are actually making. So monetary policy, now coming back to the monetary policy, basically what is monetary policy? Monetary policy is how the government, or the bank, sorry, not the government is fiscal policy, how the central banks will control or keep a lid on things, which will include like the growth of the economy and stuff like that. So there are a few different parts. One is the interest rate, which is part of monetary policy. They look at inflation, how much the price of goods is rising. They also look at money supply. Money supply is when they either put the money into the banks or take the money away from the bank. So when it's expansionary, they are giving the money to the banks by buying bonds from them. When it's a contractionary monetary policy, which they're tightening the monetary policy, they will, when the bonds come up for, because bonds are basically, they pay interest for a certain amount of time. So it's a 5-year bond. After 5 years, you get your principal back, right? So when the bonds, they come to term, they will then either reinvest that money and give the money back. So they'll buy more bonds and give the money back to the bank, or they will say, you know what, don't need this anymore. And that's it. We won't reinvest what's already expired, the bonds that have come to term. So when they take away, when they do not reinvest that money, that means they're taking money, they're reducing the money supply and taking the money out of the economy because they want the economy to stand on its own 2 feet. And this is a very interesting thing that's going on. This is a bit of a side note, but we need to understand this as traders. So currently, there are two types of policies: monetary policy and fiscal policy. Fiscal policy is set by the government, which is basically we have the tax cuts. The government can do tax cuts, or they can provide jobs. So they're hiring, things like that. So they create this flow of money into the economy. So what has been happening over the last 10 years in the US is that the monetary policy was expansionary. That means the central bank was creating more money supply in the economy. So they were trying to prop up the economy by supporting it. And the fiscal policy was also expansionary, where during President Obama's period, there were a lot of tax cuts, there were jobs created and things like that. So what has happened now with President Trump is that he is injecting more money into the economy, but the economy is already doing well. So we have more tax cuts and tax reforms, and we have a central bank that's actually pulling back. And they're pulling back because they're saying the economy is doing well and it's time for the economy to basically become self-sufficient and self-reliant, and they need to do this on their own. It's kind of like the parent birds pushing the baby bird out of the nest and having the baby bird do things on their own, because that baby bird needs to learn how to fly. But if you keep propping the economy, it can create problems because the economy will not be able to stand on its own feet. So as a result of that, we are going through some interesting times. I think we will go into some interesting time. There will be interesting times coming up because now we don't know how this will play out. And one way it tends to play out is over inflation. And that's not happening. So if central banks were pumping money, governments pumping money, the economy says that it's growing, but we don't see the inflation, that prices are not going up, that means there's a problem somewhere, right? And they can't keep on cutting rates. So there will be this interesting interplay. And this is why President Trump yesterday, so we saw things jump up, US dollar dropped yesterday because one, inflation number did not come out too well. It was actually lower than expected. And the reason it actually had such a big impact was, one, they were already expecting a low number, and then it was even lower than that. Had they been expecting a strong number and it came in a little bit lower, it would have been fine, but they were already expecting a weak number and it was even weaker than that. That means there's a problem. So we have to sort of keep an eye on that. And another thing that happened was President Trump was speaking, and he essentially said that the Fed was getting too cute, and they cannot keep on raising interest rates because it will harm the economy. So we have two differing points of views. So when we have president of the country come in and take a hit at the central bank, then it just creates that anytime President Trump comes in and says something, he wants the US dollars to go down, and US dollar does go down when he tends to speak anything about the US dollar. So when he comes and says the Fed should not raise rates, that then has a negative impact on the US dollar, because it shows the market participants that there are chances that it's not going to keep on going up in the future and it's going to lose its value. So that's how yesterday we saw that inflation numbers came negative, as well as President Trump came and said that about the economy and the Fed. So those two factors combined caused the US dollar to drop. But overall, in terms of monetary policy, we're looking at interest rates, we're looking at inflation, and we're also looking at money supply. And the fourth factor is reserve requirements. So I just talked about the reserve requirements. So reserve requirements from the banks means that if they have, let's say, $10 million, they need to have a certain amount in reserve because if everybody wants to withdraw their money, they need to have certain amount of money in their accounts so that they're able to give this money. If everybody withdraws their money, banks will not have enough money to give it back because they have used that money to lend it to others. So they have to have not all the money, but a certain amount of the money. So I'm not exactly sure exactly how it is. I have not checked how much the current requirements are because they change. They change from time to time. So let's say 20%. I'm just making this number up. So don't quote me on that. But let's say 20% of the money they need to have in reserve. So should people want to withdraw their money, they can use that money. If they have no money, then the banks are basically will go bankrupt if everybody withdraws their money. So those are called the reserve requirements, and central bank dictates what the reserve requirements are for the chartered banks. So those are the reserve requirements. And then we have how much they can give a discount when they're lending to commercial banks. Okay, goals of the monetary policy. Why is the monetary policy so important? Monetary policy is so important because what the central bank is trying to do is that they're trying to basically make the economy grow. So they want sustainable economic growth, they want full employment, and they want stable prices. So those are the three things they want. So stable prices will be your inflation that we have been talking about. And then sustainable economic growth. So sustainable is very important because when they pump money into the economy, it creates economic growth, but it's propped up. And right now, US stock market is propped up. Right? It's propped up because there's been tax cuts, there have been low interest rates, there's been money being pumped into the economy. And all of that has created this massive, massive growth in the stock market. So stock market is higher today than it was before the financial crash. And we thought there was something wrong with the system before the financial crash. So this is where things are kind of crazy right now in terms of how they are playing out. And when things go crazy, we saw with Bitcoin, when things go crazy, usually there's a crash. So I don't know how this is going to play out, but I would be concerned about that because right now things are sort of crazy in the stock market and everything's gone up and it's higher than it ever was. So the economy is good right now. It's at full employment and everything else are close to the full employment, but it's all propped up. So when that money gets taken out of the system, can it stand on its own feet? And that's what they mean by sustainable economic growth. And that's why banks are very, very careful with managing the monetary policy because they don't want to take the money out and the whole economy crash, but they keep the money in and the prices start to go up super crazy. So that's why it's a three-legged stool that they have to manage. So we already talked about expansionary monetary policy and contractionary monetary policy. Expansionary monetary policy is when the banks are putting money into the system. They will buy bonds and securities in order to give money to the banks so that they can actually lend out the money to people, which in turn will create economic growth because people will spend that money. It will create jobs. The businesses will hire people and they will buy products and so forth. Contraction in monetary policy is what we are seeing right now from the Fed, from Bank of Canada. Bank of England has just started doing this. ECB has started doing this as well. This is when they're starting to slowly take the money out of the economy. They don't just do it all at once because that will make everything crash. So the Fed doesn't come and say that we are going to raise the interest from 0.5% to 2% overnight because that would really mess things up. What they do is they do 0.25% or 0.5% or it varies from different central banks, but 0.25% seems to be what a lot of central banks will do. So they'll just raise it up 0.25%. So they do four interest rate hikes and the interest rate goes up by 1%, right? So it doesn't go up crazy. It just goes up by 1%, but it goes up by 1% very slowly. So the point of contraction monetary policy is basically to slow down economic growth and really is just to slow down the inflation so the price of goods does not go too much. Inflation. How does inflation play into this? Because that's the topic that we are talking about. When we have loose monetary policy, so this is what we have had all this time, we find that borrowing is easy, right? The interest rates are low. Banks are willing to give loans. In this case, because of that, consumers will buy more. So for example, if somebody wants to go buy a car and they see that the interest rates are really low on borrowing in order to buy that car, they will go buy that car. Whereas if the interest rate was 8%, maybe, we would not be interested in buying it. But if you can get the same car for 2.9%, yes, right? So this is because it makes a big difference in how much you pay towards interest versus the principal in that case. So this is where consumers will buy more because the interest rates are so low. Businesses will expand, like I said, because they will spend more money because the banks are giving them loans so they can buy raw materials. They will expand their operations. They will hire more people. And as a result, more people are employed. And when more people are employed, that means they have more cash in their hands. When they have more cash in their hands, they can then do discretionary spending, which means going to the movies, buying a big screen TV and stuff like that. So they will go spend more money. But when the monetary policy starts to tighten, borrowing becomes more difficult because the interest rates go up and consumers will, as a result, buy less. So let's say somebody wanted to buy an $80,000 car at 8%. That's super expensive. So they may think, okay, I'll buy a $50,000 car. So they have cut down their spending by $30,000 right there. So they tend to go with less because they're paying so much in interest. So businesses will postpone expansion because let's say if it's costing them 8%, then they may not have the money in order to spend that 8%. So their profits, cutting into their profits. So if their profit is only, let's say 20%, 8% of that goes towards the interest. So it may not make sense after they have paid the rest of their bills. They may not have enough money left in their pocket to actually make money by doing that expansion. As a result of that, they will postpone projects, and which will then mean that less people are employed. So unemployment goes up. Production is reduced because so let's say they're running 2 shifts and they find that by running 2 shifts, their costs are too high. And now because the interest rate is higher, it's cutting into their profit. That means at the end of the day, there is not much profit left. So what they will instead do is let's run 1 shift, bring the cost down, so at least there's some profit left in that. And as a result, they will cut employees and they will lay off workers, and then production is reduced, and as well as the employment goes down. So that's how monetary policy plays in. Let's take a look at important indicators. So in this case, we'll just talk about CPI here. So CPI, for example, if we were talking about pound here, Bank of England, so this is what they will look at. So it doesn't have to be Bank of England here. It could be any central bank. They look at their inflation. It measures the change of price of consumer goods. So how much does the basket of goods go up year over year? That's the inflation. So here we're talking about the British pound, but this could be any currency. So changes in amount. So things that will impact the currency will be monetary policy, interest rates, and anything that's going on in terms of the economic performance, so for British pound, for example, Brexit is playing a big role. So anything else that's going on in the market will have an impact on the currency as well. So what is CPI here? CPI is basically, it measures the price of fixed basket of goods. So they have like 600 items that they measure year over year, month over month. And the core, so there's core CPI and CPI. The core account will exclude food and energy prices because they're volatile in nature. So if you go to the grocery store and if food is becoming more expensive and your gas is becoming more expensive at the gas station, and you say, well, why is CPI not increasing? Whereas my food and energy, which is the basic things that we need to survive is getting more expensive, what's going on? That's because in the core CPI number, they remove food and they remove energy because they tend to be more volatile, and other factors will have an impact on them. For example, how much, whether the OPEC cuts production or increases production will have an impact on oil prices. If there's, let's say, a tsunami somewhere and refineries get knocked out, that will have an impact on oil prices. Or if, let's say, crop gets destroyed, that will have an impact on the price of, let's say, corn. The whole let's say there was, for example, here we have had this early snow here, and it's feels like winter. What the problem with that is that all the farmers now have a problem because their crops got destroyed because they were not able to harvest it, because they were not ready to be harvested, and the snow came in too early, so the crops are destroyed, right? So that will have an impact on price of food, because now there just isn't as much food to be sold. So that's why they take out the food and energy prices, because of their volatility. The rest of the 600 or whatever products that are left will play a role in inflation. So that's why there's two numbers when inflation comes out. CPI, there will be core CPI and just normal CPI. Normal CPI measures everything. Core CPI will remove food and energy. How does the forecast come into play? So let's talk about it as well. So when we look at the news reports, you'll generally see that there's a forecast, right? Forecasted number. How does that come into play? So basically what happens is that they ask the different economists where they think the number will come, right? Because the economists are the ones that study the economy, so they should have a feel for, or they should know where the number should come. So they will survey a bunch of economists, and they will ask them certain questions. Based on the answers from those economists, they will then basically create a consensus where they say, this is what we are expecting. So they take multiple different people's opinion into play, and then they come out with a baseline number, which they think this is the expected number. So it's based on all the forecasts that get pulled together, and then they average it, right? So if the number comes out as expected, that means it is close to the consensus forecast and it's fine. So it's neutral, right? If it's better than expected, then usually the currency will have a positive response to that, because basically it has produced a better return. And this is what happens in stock market as well. When something, the earnings are better than expected, the price of the stock goes up, because it's just all about the data that comes out, right? If it's worse than expected, and this is where worse than expected data right now is having, has a worse impact, because especially for CPI number, because CPI number is already not doing well, right? And there are concerns. There have been concerns like all this year about CPI not increasing. So if it's already expected to be low and it comes even lower, that will just double up the impact. It will just have a bigger impact. So whereas that little difference will play a big role, but when you already are projecting a weak number and it comes even weaker than expected, now what the problem that creates is that, one, it shows that there is a problem in the economy. Secondly, it then creates this expectation that maybe the Fed won't raise rates, and if the interest rates don't go higher, then the value of the currency will decrease, right? So that's the interplay there between CPI and interest rates. So expectation is created that maybe the interest rates won't go higher, and that will always have a negative impact on the currency because of that. So when we trade it, how does this get traded, right? So Forex traders will generally price in the consensus, and this is where the moves can be bigger than expected, because let's say that the consensus is that it's going to go up, right? Market's going to go up, or the number is going to come up at a certain point. It gets priced in. So if it's a positive number, people will start buying it even prior to the number that is prior to the number being released. So basically everything gets moved up then, right? because they're looking at this positive number. When the market does not, when the data does not come in as expected, everything that has been priced it now has to get undone. And that's why it creates that move. So people will just sell it to get out of it, because now their view has shifted and it creates this shift in the market price. One thing to keep in mind here, I highly recommend going to like Bloomberg and Reuters and actually reading their news stories, because a lot of times they will explain these things and it may not make sense like the first time you read it, but if you keep reading them over time, you will start to pick out these trends and what they are saying about these numbers and these economic reports that come out and how they impact the economy and the consumers and the traders. So it's a good idea to go through their news feed or the actual news stories and read them, because they will expand upon them. Hope you enjoyed this show. For show notes for this episode, please visit tradingwithvenus.com episodes page. That's it for today, and I'll see you next time.
If you want consistency in your trading, we invite you to join our daily market analysis calls, where we provide the levels to find the best entries and targets on an intraday basis. For a 1-week free trial, please visit www.tradingwithvenus.com. Thanks for joining us today. With much gratitude, your show host, Raman Gill.